talking about the inventory cost flow assumptions. Part 2, the FIFO, the first in, first out, following the physical flow. And then we'll get the same result in periodic FIFO and perpetual FIFO. So the FIFO means we consider the inventory out when you sell our inventory. First inventory, first out. We purchase on the April 1st, the beginning inventory. And then we assume that first inventory sold out first. If we sell the very similar inventory with the different amount and different the unit cost, then which one we should take? Because our customer doesn't care. Our customer doesn't care which inventory cost was. So we should consider when you calculated cost of goods sold during the April. Let's do that the periodic FIFO first, because that we already covered in the financial accounting class. So the total cost of goods sold during the period. So how do we get, right? Just at the end of the period, we measure the total units sold. So 450 plus 200. Is that correct? Right, that's correct. Then how do we get the total cost of goods sold during April in total amount? Total amount. Now FIFO 600, you don't have to calculate the unit cost at this moment. It's different. The reason why we calculate the unit cost in the weighted average is to get the total cost based on the unit cost calculation, because we don't know what the average cost was. So we calculated the first on the unit cost. But here, the FIFO, you don't have to calculate. Why? Because we are going to use the unit cost when we purchased inventory at this moment as it is. So instead we use the 650 from 250 and 400. That's all. So, okay, 2,500 plus 4,007. That is the total cost of goods sold for 600. These two inventory purchased, we sold. The first in, first out. First in inventory, first in out. So we consider these two inventory out first. In order to get specific, 250 unit times $10 per unit cost plus 400, because we sold 650 on sales April 23 and April 29th. The sales 200. So total 650. So 400 times 11.75 unit cost. So we got the same result. And then if you really want to get the unit cost at this moment, 11, just average. Then ending inventory. Now it's really easy to get. It's total inventory available for sales minus 650 cost of goods sold, so 300. What about the ending inventory? 7,200. Oh, sorry. How much was the total inventory in the dollar amount? 11,400 minus 7,200 inventory cost out, cost of goods sold. So the inventory is 4,200. Got it? So we also can calculate the unit cost like that way. Why it is the same as this? Why the $14 unit cost and the inventory same as the inventory purchased on April 28? Because these 300 units inventory we haven't sold. We didn't sell this, the inventory purchased on April 28. Why? The 650 cost of goods sold was from here, 250 and 400. And that's it. So 300 is the leftover, which is ending inventory. So let's double check the cost of goods, cost of goods sold plus ending inventory 950, which is total number of unit available for sales. Then the sum of these two also in dollar amount 11,400 is the total amount of inventory purchased. So I think it is correct. What about the perpetual LIFO? Now let's calculate perpetual LIFO system. Under this perpetual LIFO, what is the total cost of goods sold during April and ending inventory? So again, the perpetual LIFO, unlike the periodic LIFO, we should calculate cost of goods sold every time we sell the inventory when we made sales. So that is perpetual recognition of inventory out. So cost of goods sold 450. Now cost of goods sold 450 starting from this easy one. And then how do we get this the cost of goods sold now? It is first in first out, right? So 250 times 10. Now we take 250 out of 450 plus, now it is important thing, 200 out of 400 inventory purchased on April 15th. So 200 now times 11.75. So that is the FIFO Perpetual when we sell our product and then we recognize cost of goods sold along with the matching principle. So 4,850 is cost of goods sold in total amount. So unit cost should be $10.78. But it's not a good necessary information because on the financial statement, the income statement, the cost of goods sold doesn't show the unit cost. That's fine, but it is for just internal information. Next, the cost of goods sold on April 29th, we sold 200 units. So cost of goods sold, number of units 200. And then, now, how do you get it? That's correct. This 200, where did you get this 200? Where did you get this 200? Now this 200 comes from here, right? Comes from here. So 200 out of 400. We already counted 250 and 200 out of 400 in the cost of goods sold April 23. Now 200 inventory purchased on 15th, April 15th is remaining. Now, even though the company purchased inventory 300 units on April 28th, it is not the cost of the inventory out. It's not the inventory out on April 29th because we're following the perpetual FIFO. So we should consider the leftover on the April 15th we purchased. So the left amount, the remaining amount is 200 out of 400. So 200 times the unit cost is 11.75. That's it. So 2,350 is cost of goods sold. So for the internal calculation, internal information users, so the cost of goods sold unit cost is 11.75. Now the total cost of goods sold in units is now the same as other exercise. Now the sum of this cost of goods sold is now 7,200. So let's divide. What about ending inventory? Also the same procedure, 950, the total inventory, the number of units available for sales, minus 650. Okay, then the ending inventory, also out of a total 11,400 total inventory purchased minus 7,200. Okay, it's a very simple way, but in order to make sure that is that the right end inventory, now we can calculate this amount a little bit different way. How? That's correct. Now this 300 times $14, that is the remaining. Why? Because the sales we have been selling the sales 450 and 200. So the remaining is always ending inventory. So 250 and 400, we sold 450 and 200. So the remaining, the ending balance of inventory in number of units is 300. So 300 times 14. So we got, so we got the same result. So let's sum up these two. So we got the answer. Then do you see the result? Let's compare the periodic LIFO and perpetual LIFO. In two cases, the total cost of goods sold during the period are the same. And then ending inventory also are the same. Why they are the same? Why are they the same? Because here, when you calculate the periodic FIFO, we starting from the first in inventory. Also, the perpetual LIFO, regardless of when they recognize the cost of goods sold, we considered the beginning inventory because it's the first in, first out, right? First in, first out. So even though we sold 200, it's still we consider this 200 from this leftover, right? So it is just in order, starting from the first purchase, so beginning inventory. That's why the period FIFO and perpetual FIFO have the same result of the cost of goods sold dollar amount and the inventory as well. Okay, good. I think we can move on to part 3 to the next video clip.